All right, so after a pretty eventful weekend, it was a very uneventful Monday, which is typical. Typically, Mondays are pretty quiet, especially when there's nothing on the calendar scheduled. At least, of course, we had the Apple event and the news around this Mueller report being released over the weekend, and the impact that it had over what was a bearish end to the week last week. So we're going to talk about what to expect now for this upcoming week, based on what happened today and take a look at a sector in the news that has produced a stock that's catching some flack from a primary driver for the weakness in that sector, and take a look at how to trade that. So let's go ahead and get started. Today is Monday, March 25th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off looking at the S&P 500 with the market forecast indicator. You can see we're not pink today, but we're getting really close. The intermediate lines finishing today at 80.13. Actually did flirt with dropping below 80 during the day when we were at our lows, but we did come off the lows a little bit. So we're still got a strong bullish posture according to the intermediate line, but that may last another day. Barring a big jump to the upside tomorrow, that's probably going to last another day. The market sentiment is still rising, so again, it's not like we're transitioning here to a strong bear market. This is a little bit of a pullback that we're getting, similar to what we've seen before this 5 days, which wasn't very much of a pullback either, relative to the rally we had before that. And even here, we're only about halfway down the last near-term run that we had. So that's kind of what we're looking through. We did break through these lower lows, and after getting a bearish near-term high point right here, a high between 50 and 80, but lower than the last high, and you can see that it's up here as well, a divergent high because we were actually higher in price. We are now pulling back more. We got that extreme low on the momentum line Friday, and now you follow that up with a pretty deep drop on the near-term line today. That's about as bearish of a near-term sentiment, a short-term sentiment as you can get. Those two patterns back to back. So it suggests that we'll get a bearish posture. We already do have the bearish posture, if you recall. Sorry about that. On the Russell 2000. In fact, if you look at the moving average here, yesterday was at 1555.65 right here. I'm looking at that number right under the D. So 1555.65 today. 1555.86. So we'll still stay yellow tomorrow for another day, but that's coming off of just barely going up a little bit. So we're gonna keep our eyes on that for that to turn lower, because if and when it does turn lower like it did over here, and then the line will turn red, and that combination of a red moving average and dark pink shading is a pretty bearish combination, and the intermediate posture doesn't look like it's going to be turning up anytime soon. So we're gonna really closely watch that to see if we end up getting that bearish combination on. We actually would expect that because of the pattern that we're getting here. Remember, the S&P got above these corresponding highs. The Russell obviously did not, and the S&P actually got above that high. The Russell did not, and we're already dropping below that previous low point. So it kind of gives us an idea of what the S&P could do, just like it did back in late September, early October. The small cap stocks is showing us what we may anticipate seeing on the S&P. The Dow is already kind of a little bit ahead of the stage, in its stage of weakness, than the S&P 500. Again, the intermediate line's rising. We got 25,731 to 25,745. So we're not going to have a red line yet. We don't have dark pink shading yet, but we're going to keep our eyes on that to see if that combination comes out as the intermediate line rolls over. We did get the extreme low on the momentum line. We did get the dip into the reversal zone by the near-term line. That's a bearish combination. Not really a good sign. The intermediate line is not able to get above 80, and we're not getting to a new high. So, we're getting some bearish patterns on these indexes, but that's to be expected. We were expecting an intermediate pullback. We're not expecting a bear market. We're not expecting the market to go, the world to end here. We're just finally looking for a little bit of an exhale that appears in the last couple of days, so far at least, that we're getting. Again, the NASDAQ composite even showing similar short-term pattern. Not bearish yet, not even weekly bearish yet like the S&P. It's been holding. It's been the leader. It's way gone up above those highs. Remember, the Russell's already below these lows. and never did. The Russell and the Dow never did get above these highs. So you've got a lot of relative strength in the NASDAQ to work out before it starts showing similar bearish patterns to what we're seeing on these other indexes. All right, before we look at some other charts, quick reminder, subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Click that red subscribe button that pops out. There's also, if you're on the desktop version of the web, there's a subscribe button down below the video. Click the thumbs up icon that's also down below the video. That lets us know that you want us to do the video again tomorrow. Quick, easy way to give us feedback. You can do that right now while you're watching. Also, while you're down there, comment on anything that stood out to you today. Love to see what you're getting out of the videos day in and day out. Great comments, and I appreciate those comments that come in every day on the videos. Join our Daily Market Outlook email list. There's a link popping out in the top right corner of your screen up there. Really easy way to subscribe to it. Click that link. We'll take you there. Follow me on Twitter for more content like this in between videos throughout the day. And join our daily market, join our Market Outlook community. I make that mistake every day. Join our Market Outlook community that we've created on Facebook. Also, while you're watching the video here on our blog, down below the video, click on this heart. That will take you to today's Market Outlook tweet on Twitter. Hit that like button. Click on this image. That takes you to the Market Outlook post on Facebook, where you can like it there and share it with others. And of course, you can click here. Those 3 clicks, just like on YouTube, tell us that you want us to keep doing the videos. And tell those social networks that you want them to keep pushing you our stuff among all the other people and accounts that you follow. All right, well, back to the charts, and you can see on the weekly chart that long lower shadow we talked about last week so far showing the weakness, not only here on the regular candlestick chart, but the Heikin-Ashi. Look at that transition candle again forming. It would take a significant move to the upside this week to get another bullish candle. Not out of the realm of possibility. Of course, it can happen, but so far looking very predisposed to another transition candle like we got here. And again, those expectations for those types of candles are for the reversals, in this case a reversal to the downside. If you look at the 3 green arrow chart, you can see we got 2 red arrows. We're not close to that 3rd red arrow. Remember, the S&P is not close to rolling over on the moving average either, so we don't have that bearish combination pattern yet like we do on the Russell 2000, which again, remember, is very close to rolling over on the moving average, and does have 3 red arrows, right? And you look at the 2-line versions for the S&P. There we go. So you can see again, we're flirting with the 17-day exponential, but we're still above the 30, so we're easily still above this rising trend line. We did get this divergence on the MACD and the stochastics. They're both falling below the moving averages, but they're both still in the upper half of the chart, so they're both still in bullish territory. So, you know, again, no danger here of like bear markets or this being a bear trap, a bull trap, or whatever, right? It's, you know, we are just pulling back what we have, you know, a lot of what we've gained over the last little bit. The Russell 2000 is in bearish territory, both on the MACD being below 0 now, pretty decent move below 0, and the stochastics peaking with a bearish high point, a phantom red arrow moving back down below its moving average. So you can see both the 8 and the 17-day moving averages both below the 30 days. So that's a bearish, you know, about as bearish of a pattern. Again, can suggest what we can expect to see on the larger cap indexes. They just have more room to fall, right? The NASDAQ composite. Sorry. You can see is even more bullish than the S&P is, easily above, still at its 17-day moving average, also showing the divergences, but also still very bullish in its oscillators. So no threat yet of any bearishness. So we've got a lot to work through here before, and as I've shown you before with the Bollinger Bands, SPY has got a lot of volume support down below where we're at. We're not going to be tanking here. You look at QQQ, which is the NASDAQ 100, the biggest 100 companies in the NASDAQ, lots of volume support where we're at right now. So, you know, we're just looking for a pullback. That's nothing more than that. Any weakness we may be getting right now shouldn't be viewed in any other light, despite whatever headlines may suggest or whatever people might be talking about. We've had a nice run, and when you take a deep breath in, you have to exhale. And you know, whether or not you can count that as an exhale, which I don't because it was too shallow, We do need to get one at some point in time, and we've had a really good deep breath in, and we've reversed enough to reverse that big bearish move that we've had. Now to keep it going, we need an exhale so we can bounce off of a more solid base and have a more extended rally into the later months of this year. The S&P is flirting with its 4-week range on the intraday chart. Did get a lower high and a lower low. We are trading below last week's low point, which was Friday's low. Just barely though. We've been flirting. We off the lows today. We jumped up to test those highs, those old low points as new highs. Volume was relatively high, not as high as it was on Friday, but a decent move in volume. In fact, if you look at the volume on this chart here of SPY, you can see not quite 1.5 times, but 85 million shares traded. We were just a little bit below average, so it was a much smaller move than what we saw. If we take a look at the grind here, this chart, you can see 85 million shares will still continue to bring that line up, and 2.5 points is below the average, so that's going to halt that momentum. If we can slow down on the ranges, we had two really big ranges on Thursday and Friday. If we can get back to like ranges like we had today, great. We might not even get the intermediate pullback that we're expecting. But if we continue to get bigger moves in the 4-point range, and 100 million plus volume shares, then that's what's going to cause us to have this pullback. That's going to be coincident with this pullback. So that's kind of things that we'd watch for. Volatility, it continues to trade in the upper end of the neutral zone towards the bearish territory. We're in the upper teens on the VIX as a whole. We are relatively high. So you would expect some kind of pullback here, at least in the short term. And if we are going to stay bearish, we might pull back down to say 16 before we bounce up. And I'm not looking for extreme moves above 105%, but up to closer to this 100% would not be out of the realm of possibility at all. All right, so that's my market outlook for you now, going through our technical routine here. Now I want to hear from you. There's a poll popping out there in the top right corner of your screen. You can vote whether you agree or disagree with that market outlook. Just click on that link that popped out. Hit the either agree or disagree. If you click disagree, scroll to the bottom, type in what you're seeing that prompted you to disagree with that outlook. What do you see that's different that you would like to share with other market scholars that watch these videos day in and day out? All right, let's take a look at what's driving price action today. And it was a quiet day on the calendar. In fact, if you look at the calendar here, there was absolutely nothing. The Chicago Fed National Activity, which is a summary of all those surveys, it came out. It rose from what was a revised number, so it actually fell a little bit, but it rose from what the original number was. The 3-month average, moving average, has fallen into negative territory. Not surprising that we've gotten a few months here with negative numbers. Again, contraction level is expansion contraction levels at 0, so it's telling you we're in slightly contraction areas. And economic indicators have been really volatile. It's really quick moves to the upside followed by quick moves back down. So it continues to show really strong negatives in the U.S. as well as abroad. In fact, today the odds of a rate cut at one point in time today had risen up to 75%. So the odds of staying here by the end of the year had dropped below 25% earlier today. That's when I tweeted out about it. And so even still, by the end of the day, we're still close to about 70% odds of a rate cut by the end of the year. That's pretty significant. Oliver Rennick from TD Ameritrade Network tweeted out, what do we watch for next? Now that we got the yield curve inversion, what do we watch for next? And you can see there's very little moves here on anything. The dollar was flat. S&P was flat, high yield bonds was crude oil was flat, developed markets were flat, emerging markets up a little bit, but just barely more than 0.25%. Gold was up the most, even though the dollar was only down just a smidge, and small cap stocks were up. So not really a big risk off day when you see small caps and emerging markets outperforming along with gold. So, but all of them are very small moves. And again, not much going on today from a news cycle standpoint anyway. We did obviously have the Mueller report over the weekend, but that didn't come back. The markets actually sold off a little overnight on Sunday night. We started bearish here. Crude oil was down more than 1% early before rising up and then finishing flat. Everything rising back up off the lows and then just finishing nowhere. But going back to what Rennick was saying, and it's like, okay, what do we look for now? Now that the yield curve is close to inversion, it hasn't inverted on the 210s yet, right? That's kind of a key one to look for. But now that we got that yield curve, or we're at least on the doorstep of that happening, what do we watch for now? Now keep in mind that the yield curve inverted back here initially for the first time back in December of 2005. I remember the Fed hadn't stopped raising rates yet at that point. They raised rates for the last time in June of 2006. The stock market, remember, peaked in October of 2007. So by the time, in fact, by May of 2007, so more than almost a year and a half, well, pretty much a year and a half later, the yield curve was still inverted. So, this is not like an overnight trade signal, right? In fact, and again, that's May of 2007. That's 5 months before the market peaked. So the market didn't really peak until we got up to this point. And you see how the yield curve had already started to rise. There's two reasons why the yield curve rises. Number one, it rises because the short-term rate falls. And number two, it rises because the long-term rates rally, as you can see here, rally more than what the short-term rates rally. Right, that's kind of the last stages because the initial surge up is because the low end falls, and then as the low end gets to low levels, the high end, which measures economic growth expectations, rises. Then the Fed starts to raise rates because the gap gets so big between the 10 and the 2 years. The Fed starts to raise rates. They raise them up, and that's when it falls down again. And then again, usually. The yield curve inverts because the long-term rates fall relative to where the Fed has set the short-term rates because they stay stagnant. So right now the Fed set the short-term rates, and so far they're keeping it stagnant, and long-term rates are falling. The yield curve has not started to rise yet. Again, it'll either rise because the Fed's lowering short-term rates, which they're not doing yet, but the futures market's suggesting that we could have one by the end of the year. But again, that's just expectations. That doesn't mean we have to get one. The market will start pricing in. See here, September of 2007, right where my cursor is. You can see how much the lower term rates had fallen by the time the Fed actually did drop the rates. So, and you can see how much the yield curve had risen already by the time the Fed did cut rates, for the first time. So that's the key to watch. The fact that we're inverted, we could be a year and a half of having inverted yield curve. Plus, and then it was another 5 months before the stock market finally peaked. So, we could have, almost 2 years of the market still rallying, despite the fact that, and remember, we're not even there yet. We're not even at an inverted yield curve yet. This is updated as of, this would be updated as of, still on Thursday, so still doesn't have the Friday's data point. So we're not even there yet on the 210s, mind you. On others, like the 3-month, we are, but not on the 210s. You can see there's your 10-year, and so when we get Friday's data points, you'll see a lot of these short-term yields rising up above the black line. But the purple line hasn't, and that's the 2-year. That one hasn't risen above the black line yet. So again, we're not in any danger of bear markets, and when the yield curve does start to rise, and it's because the short end of the curve is falling, then we can start looking eventually, not immediately, but eventually towards towards the peak in the markets. We would be in the 9th inning at that point of the game. That can go in the extra innings, right? But we'd be at the very end of it, and we'd be looking for that. And that's a period. Remember, commodity prices do very well in that environment. The dollar's weak in that environment. Industrials, energy, material sectors do very well in that environment. International stocks also do well in that environment. Now, if we take a look at the sector moves, you can see today discretionary, industrial, staples, utilities, kind of a smorgasbord of different sectors. Again, very small moves. So discretionary is the only one outlier to the upside. On the flip side, technology, semiconductors pulling back, giving up some of their strong gains. They're not trending lower. Excuse me, they're just giving up some of their strong gains. Same thing with communication services with recent gains in Facebook and Netflix and Google. Of course, the financial sector continuing to lag because of that falling yield curve, and that really weighs on them. So everything else about as flat as a pancake. So very low news drip, despite the fact that Apple had its event today and the Mueller report over the weekend. The market kind of taking a little bit of a pause, but that's a good thing, right? If the markets were really like plummeting, we'd be following up some pretty big ranges on Thursday and Friday, up and then down with bigger ranges today, right? And that's when you'd worry, right? When you get such big moves, day after day after day, and we're not. So if we get a little moves here, bigger drop there, followed by a little more, more little moves here and there. That's typical of an exhale, and as of right now, it appears to be what the charts are suggesting. All right, so for our trade idea of the day, I want to take a look at one of the weaker sectors out there right now, at least temporarily, and a lot of it because of Boeing. But that is the industrial sector. One of the weaker stocks right now in that sector is Delta Airlines. And you can see it's actually showing a bearish pattern here. It's got a bearish short-term sentiment. The intermediate line's dropping below 50 from a bearish intermediate high point. The red line, you got dark pink shading, you got dark red line, you got three red arrows on the 3 green arrow chart. So you got 3 red arrows with the red line. You take a look at where the MACD and stochastics are, both of them below their midpoints of the chart. Now the MACD is below zero. It's not sharply below zero yet. It is breaking through its trend line. Depending upon how you draw it, it is breaking through that trend line there to the downside. The 8 and the 17-day moving averages are both crossing below the 30. They're all falling. And of course, the 50-day, that delta's been in a death cross here on these long-term moving averages. We just barely retested up towards the 200 and are rolling back down below a falling 50-day moving average. So it's on a bearish trend, lots of bearish patterns. It is breaking through some volume support here right around $50. So that doesn't help. A lot of volume resistance up on top of where you're at right now. Then you look at the DMI indicators, and you can see they're all bearish. Delta Airlines here, you can see the oscillators below zero. The stochastic extreme is down to the downside, and you're almost about to cross above 25. And the positive is already below 20. So almost got the bearish combination there that you're looking for on the DMI. So bearish all around the board here. You can sell. We still got 24 days left. You can actually still sell this 50.5 strike at the 37 delta. By the 52.5, you get 47 cents is what we need, right? So we can actually probably get about 54 cents right now. When you look at that, you can see where here I got 56, but you can see the break evens at $51. I can go up a few more to about 51.5 before I lose $56, which is what I'm willing to lose on this trade. And you can see essentially we'd have to get back up above that high point that we're breaking down from for us to take the loss. And of course, as always, if we can get half of that gain, we'll take it, right? Because remember, we can make quick trades depending upon your commission schedule. Right? Some brokers may not charge you at all to exit trades. That being the case, you can go for half of that trade. $28 would be because you see how easy it is to get the first 28 and how hard it is to get the second 28, or how long it takes. So if we can get 28, then we can move on and look at some other trade and try to get that next 28 on another stock, which is easier at the front half than it is to get it on the second half of this one. All right, well, that does us for today. As always, I want to hear from you now. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums on marketscholars.com. Any questions or comments about anything we discussed in today's video or anything we didn't discuss. You can be able to open a new thread there or reply to anybody else's thread and be able to continue this conversation that we have from video to video. Again, you have to subscribe to our site to be able to participate in those forums, but you can do that really easy for free, as I showed you before. Again, thank you very much for watching. Have a great rest of your evening, everybody, and we'll see you all tomorrow.